So we were on this deferred consideration. So you can see this is what you do on initial recognition, but now you can go on and see further. After whenever you discount something, it means you also have to account for its changes later. Remember, you had to pay you had to pay a different figure, but you discounted it. So this is what we do, right?
Okay.
Compute the finance what? The finance cost. And how do we get that finance cost? You take your rate, that which was 10 per what? Percent, and you multiply by this figure of deferred consideration that you have here. And you have 12,600, right? This will be the finance cost annually. Remember, you have discounted something, and that is the figure that you have on first October 2013. So if you multiply and get the finance cost, that will be the finance cost from first October 2013, 1 year later, right? Up to 30 September 2014. But look, your year ends on when? When? 31st March 2014.
This month.
So you look from acquisition date, it's here. And the reporting date is only 31st March 2014. It's only 6 months, right? So you also have multiply by 6 over what? Over 12, because only 6 months have elapsed. So you'd get that finance cost, and maybe you could determine that double entry. You could just debit
Finance cost
by how much?
by
6,300.
6,300.
Yes, and then credit deferred consideration. That's our meaning. Consideration should be increased until it reaches the actual figure and be paid, right? So that's what.
Okay.
Now, see, deferred consideration is a liability. It goes to the statement of financial position, and it's none of our business here, right? But finance cost goes to profit or what? It affects the statement of profit, right? So from that moment, you
Yeah.
would come and say, so we are dealing with something else, but it has come to affect the statement of profit or what? Or loss. And you can see,
Yeah.
I think, don't we? Okay,
It's there on top.
yes,
Yes.
this one, right?
The investment income. Yes.
Yes, so you could come to the income statement here and start. It's not bad. You can just come down here and say, oh, I have my finance what? Finance cost, right? And what are we going to do with the finance cost? I think it's reasonable. We have the parent, which we take as we have 2,000, and subsidiary is 5,600, right? So the parent is how much? 2,000. But the
2,000.
subsidiary is 5,600. But remember, like I told you, you acquired the subsidiary 6 months before the year end. So you only stayed with the subsidiary for 6 months. You stayed with the subsidiary for only 6 what? Months, you can see here.
Months.
Months ago
Yes.
from the date of reporting. So if that is the case, it would mean that you would have to apportion this, right? 5,600, you'd have to multiply by 6 over what? Over 12. Right.
So
So
it's very important always to start with this group structure.
yes, it's very important.
Calculate. Yes, it's very important.
Without group structure, first of all, you won't be able to know whether that is a subsidiary or not.
Yes.
Response. So
And the period.
yes, but it also gives you information on the period, because in case you would have acquired this maybe 2-3 years ago, it would have written there 3 or 2 years ago. And if it's three, the income statement is always prepared for the year, right? So
Yeah.
if it's at least 1 year, it would mean that you don't need to apportion, you would take everything. You shouldn't forget there, and since it's written 3 years, you multiply by 3, eh? Right.
Yes. So just there, sir. So if it's 3 years ago, what will happen?
Remember, look, this I told you, you have to read here. You are told these are the figures for the year ended. It is only for this year. It means it is from 1st April 2013 to 31st March 2014. So if it was 3 years
Yes.
ago, it means all of these results were there actually when Pencase had already acquired Sphere. So you just add them together in the year. You don't need to apportion. You just add them in the year.
Okay.
It is not
Okay.
like you multiply that number, right?
Okay.
Yes. So after this, you can add that what?
6,300.
Yes, right, 6,300. This one. Right, just like that. So this is what I'm going to do. Let me copy this, right? And I don't know, I should put it here, but it's fine. It's fine. Okay, let me choose to put it maybe here. So just say equals to and paste that figure there, right? You know, I'd introduce my own commas just for sure on the left side, but this is the actual computation. Yes, so we have that one, right?
Yes. The
Okay.
finance has also two F,
As what?
two Fs.
I didn't get it.
Finance, the
Okay, okay.
finance
Okay.
and two A.
So it's finance, finance, right? Cost.
Yes.
Okay, that's good. So we are done with this. We're done with the finance cost issue. Let's go on, right?
Yes.
Yes. Of course, if you wish, you could also start consolidating these ones, right? These figures. It's not bad, but also it's not so necessary. Okay.
You've taught me to start with calculations at least.
Eh?
Because those are, I think, are much better, much easier.
Okay, this way.
Yes, to start
Okay.
with calculations unless if you find something from
Okay.
calculation.
Yes, you know, when you get used at the very beginning, you need to only focus. You at the very beginning, you don't look for ways to get marks quickly and release the pressure. At the beginning, you look for ways to get used and you know to be robust and know that in an exam you have to be ready. But then when you go on, you understand everything. Then you would say, okay, let me just take this in advance, right? Take this in advance and finish up. Right. Because, you know,
Okay.
let me tell you one thing, you know, even when you take these figures, you say this plus this,
Mhm.
right? But you haven't done any adjustments. I think even the allocation of marks would be minimum because they know that everyone can do this, right? Everyone can say, okay, this plus this, right? This plus this,
Yes.
yes. But those adjustments are what actually will carry heavier marks, right?
Okay.
Okay. So like here we have
This consideration is 50, it's 6.5 marks.
hello?
Is it 25 marks the total?
I don't know.
Involves a lot. So suppose to that this isn't it. Hello, hello.
Hello.
Yes, now you're back.
Okay. So you can see this, eh? Let's go on now. You know, our main goal right now is what do we need?
To finish.
We need the goodwill. That's our first thing that we needed. But like you can see, whatever you see, you had goodwill here, but you did something that touched the income statement. So you can say, I'm going to do that later. That's where the problem to start. Whenever you see something affecting you, how you better deal with it right away. Right.
Yes.
Okay, now let's go for the NCI at acquisition. Eh? You know, if the NCI is measured at fair value, it's simple. You can get it without getting the net assets. But if it's is a proportion of net assets at acquisition, then you have no way. You first have to get the net what? The net assets, right? So let's
Yes.
the
At
NCI,
acquisition.
yes, the method is usually specified for NCI, so you can just cross-check quickly. There is always a note. In cases, policies to value non-controlling interest at the date of acquisition at fair value. So you know you're going to use the fair what? Value.
Yeah.
And common for this purpose, we usually use the share price of the subsidiary and yours you can see here, share price of Sphere at that date of
Yes.
be used, right? So we use the fair
Yes.
value so we can get it without using the net assets, without getting the net assets, right?
Yes.
I think the information was given. Look, we acquired 90 million shares out of 150. So this question is very clear. We already know the number of shares of non-controlling interest. Eh? It would be 60 million.
Yes.
150 minus 90. Or you could say, you know, this question is a bit different. It's also direct. Or you
The
could say,
percentage.
I'm warning 60%. So 40% is for some.
Yes.
So 40% times 150, right?
Yes.
That's also a
And
thought. Okay, let's say maybe it's 100% minus 60%, which like you want, right?
yes, sir.
40 times 150 million. So I'm just writing 150,000 here, and then it times
Yes.
the fair value of the shares of the subsidiary, which is how much? $2.5 per share. So times 2.5. Get that right. So that's your non-controlling one, non-controlling interest. I hope that is fine. Hello?
Yes, sir. It's very fine.
Now let's go to the fair value of net assets at acquisition. Let's say this is working 3. I think we are yet to deal with working 3.
Yes.
Okay, let's go for working 3 now. Working 3, go to the working section here and say working 3.
Yes.
Let's just go parallel, you know, I don't want to go so down. So I would say, I would come here and say working 3, fair value of
And assets, that's acquisition.
that reporting. I could say at there or below, whatever you want. That's no big deal. So we have at acquisition and then at
Reporting date.
yes. So let's get it. As usual, when you speak of net assets means equity. So I would first go to the statement of financial position and look for equity. But unfortunately, we do not have the statement of financial position here, right?
Oh,
Yes. So, but we know the components of equity: share capital, share premium. If you have the revaluation surplus, right? Things like those.
yes.
So we
Yes.
can see here because we are told Pancake acquired 90 million shares, 150 million, $1 equity shares. So if you take 150 million times $1, which is the nominal value of the shares, you will get 150 million in equity share capital. I mean, so I could say my share capital is how much?
150
Say
million.
150?
1,000.
1, right?
Yes.
And they would have the same figure at what? At reporting, unless we have been provided with contrary information contrary to that, right?
Yes.
Just like that, and we'd have that, then we'd look for maybe the share premium and the what, but it's nowhere to be seen here. It's nowhere to be what? To be seen.
Yes.
Yes, nowhere to be seen. And we are told the retained earnings of Sphere brought forward on 1st April 2013. This is not the year end, eh? 1st April 2013, the beginning of the year, we are 120. Of course, we want at acquisition and at reporting. Right? So
Yes.
I'll have this one at 1st April. This one. Okay, that's good. If we have this at 1st April and we have the income statement also has the profit. Eh? Here is here. We have the profit for the year here, right? It's how much?
Yeah.
80. So if it's
Yes.
80, and look, from the date of report, from the date of acquisition to the date of to what from acquisition to the date of reporting, it's 6 months, is right? So
Yes.
the start of the year to the date of acquisition, it is 6 months. So I could say
Yes.
120 plus 60 over 12 times this 80,000, right?
Yes.
Okay, so I would come here and say, okay, I have the retained
Mhm.
earnings, right? And say, at acquisition, I had, so at the beginning of the year, I had 120, but if I take 1 year later, I would have an extra 80, right? But you know, the acquisition is not 1 year from the date of from the opening date. It's only 6 months ahead. So that 80, I would have to multiply it by 6 over what? Over 12, right?
Oh,
Yes.
yes.
What about the reporting? The reporting, it would be easy now because I have the retained earnings at the beginning, but also I have the figure for the entire year, right?
Yes.
I would have 200 what? I hope that is fine. Of course, I don't think we're going to need it here. You know, we are not preparing the statement of financial position. We only did the figure at acquisition, right? That's what we need. I'm just trying to show, but this is like, let me say that we're just training here. So let me put it this way. We'll just compute it, but we won't use it, right? You just look at the figures, something like this. You just look. You have the figure. You have the figure at the beginning. At 1st April, you have 120. And this, remember, at the beginning of the year, at the beginning of the year ending 31st March 2014. So if you take 120 plus that 80 will take you 1 year later, which would be 31st March, and which is the reporting date. That's why the retained earnings at the year end, I've just added this one plus 80, which is profit, right? And be careful, this is retained earnings. It is affected by profit for the year. Do not add the other comprehensive income there.
Okay.
Yes, I hope you got that right.
Yes.
Okay. As you can see, of course, we have the gain also in revaluation. We have this information. So in reality, we could also have something like the revaluation surplus. We could also have something like that. But of course, for our case here, we actually don't need that. So that's why I just put it there. We don't care about that, right? Let's just go on with other matters. Let's now go for the fair value adjustments. Fair value what?
Adjustments.
Adjustments. Okay, what do we have? What do we have? And I think you can go here. So I think we are done already with all this. Let me highlight them like that. We have gone through them all. Let's go for the fair value adjustments. This one, fair value exercise conducted on October 2013, which was the date of acquisition, concluded that the carrying amounts of Sphere's net assets subsidiary were equal to their fair values with the following exception, right?
Yes.
Fair value of Sphere's land was 2 million in excess of its carrying what? Amount. So first of all, we have what? Land. 2 million in excess of its carrying amount. So I just write 2,000 there, right? And then I would also put the date of what? Of reporting. Of course, we don't care so much about this, like I told you. Maybe let me cut here and place something here. For example, maybe you could have the revaluation, like I told you, surplus, but we do not look for that, right? No need. Just say no what? No need. We are on the statement of profit or loss and other comprehensive what? Income. Let's just so you'd have the land here, 2,000. Like if we had the income, the financial position would debit land, and then we have credited their net assets, right?
Yes.
Let's go next. An item of plant had a fair value of 6 million in excess of its carrying what? Amount. So would also do the same. It's a plant. So I would say plant. I would come here and say 6,000. Of course, I would have 6,000 again. If we still had it, if we're preparing the financial position and we are told this plant had been sold by the end of the year, here we'd have 0, right? Because it would eat the books. And then what next? Here we are told the plant had a remaining life of 2 years at the date of acquisition. You see, so by the date of acquisition, this life, and the plant depreciation is charged to cost of sales. Now you get the point. Now you see.
Yes.
That you have depreciation there. Maybe I could remove this. Maybe I could just I would just be. Let me just do this, right? So I would say that we have the plant here. So we have to do what? To depreciate it. Of course, it won't affect the date of acquisition, right? It don't affect the date of acquisition. It don't affect the figure at net asset acquisition because we say depreciation doesn't pay acquisition. What? At reporting. Right.
You've gone.
Saying that the depreciation won't affect the net assets at acquisition. It would only be at what? At reporting. Right.
Yes, sir.
Yes. Let me delete this, we don't need this, so we'll just do it this way. Okay, but for the sake of the exam, you can't leave that line item. You say, okay, I had depreciation here, so I need to know the depreciation that should be taken to the income, what? To the income statement, right? It had
Yes.
the life of 2 years, so you can get the depreciation. How do we get depreciation?
Acquisition
And
amount.
first of all, we are told it goes to
Yes.
cost of sales, right? Cost of what? Of sales. So I could go direct there on the cost of sales and do the computation. Let me go
Yes.
the cost of
Okay.
by that. Cost of after revenue, we have cost of what?
Of sales.
Sales, right? Yes. So I just the cost of.
Yes.
Let me go. Let us go for the figures. Cost of sales, how much? 400 and 150, right? So it's 400, right? 400, 400K plus how much? 150K, but that 150 is usually it should be multiplied by 6/12, just like we said, right?
Yes, sir.
So I would also come here and say 400 plus 150 times how much? 6/12, just like that. Okay. Now let's
Yes.
get the depreciation. How do we get the depreciation? We are told it goes to cost of sales. The normal formula for getting depreciation. We have the
Yes.
plant at 6,000, right?
Yes.
Yes. So it will be 6,000 divided by 2, first of all, right? We need to get the depreciation, remember. So it's 6,000,
Yes, sir.
6K divided by what? By 2. We get the depreciation per year, and then you multiply by the depreciation that was incurred during that year. We acquired it mid-year, so we only stayed with it for 6 months. So how to multiply by 6/12, right?
Yes.
Yes. So if that is the case, then I would come and add here. So I would just say 6,000. It would be 6,000 over what? Over 2, right?
2
Times
times 6
6
over
over
4.
12. Right. I would get that. You see that? So everything would also be fine as for that line item would say, okay, this is what we usually do, eh? We do that. Maybe if it was a statement of financial position, of course, I would have passed the entries here too, right? So everything would be fine. Okay.
Yes.
And going further, what
Are we not showing here
where?
the depreciation?
Look here, I decided that the net assets should be shown only at acquisition. I don't need them at reporting. Acquisition, it won't affect.
Okay.
If I have it,
Okay.
it's right. But
Oh,
yes,
yes, sir.
we are
Okay, okay.
we are
I
preparing.
understand.
Yes, just for the sake of what? Of computing goodwill at acquisition. That's why I deleted that other column. Right.
Oh, but we did it in the profit or loss. We showed it.
Yes, we showed it because we need it. I don't know what the problem is. Here and this net assets is equity. We don't need the equity at the reporting.
Mhm.
If this doesn't matter, you can say if you didn't put it there, we put it there. You know what entries should be passed if you have that depreciation. If you have the
Yes.
depreciation, we credit the asset and then we debit the income statement. Is it wrong? That's the entry for
No.
depreciation. You credit the
Ah,
you credit the asset and you debit the income statement. We have put it there,
yes.
we have debited the income statement. You have to credit the asset. But it won't matter. We are not preparing the statement of financial position because
Okay.
it would affect the asset, but not at the acquisition, at the reporting. And we do not need that figure at reporting. But the entry should be there actually in case we prepared what? The statement of financial. Yes.
Okay. Now
Whenever
I
get that,
understand. Okay.
yes, whenever get that, ask yourself on the double entry and you would get the answer, right?
Okay.
Okay. Then where are we going next? Here, Pancake also placed, I think you can see how I go through this, right?
Yes, sir.
I go through, if you do this, you won't leave anything. And if you get used, actually, you just do it very quick and you won't have to retrace the steps. Pancake placed the value of $5 million on Sphere's good trading relationships with its customers. You know, customer relationship is an intangible asset. Eh? When you have the good customer relationship with the customers, when you have the good customer relationship, I mean, it would bring more value to your company because it would be easier for you to sell goods, right? The customers will build your reputation. Can you hear me?
Yes, I can hear you.
Okay, so we are told Pencast expected on average a customer relationship to last for a further 5 years. From the date of acquisition, amortization of intangible assets is charged to administrative what? Expenses. You can see that. Eh? So
Yes,
first
sir.
of all, we have another
Administration.
adjustment in terms of customer what?
Customer
Relationship.
relationship.
How much? It was 5, eh?
Yes.
5 million. Okay, where are these gone? I don't know what happened. Let me try to put it properly. Okay, it's fine. 5, right? Okay, I remembered. I did something here. 5,000. Okay, it's fine. Okay, what do we do next here? We go for the amortization, right? And the amortization, as you have been told,
Going to be, yes.
are the main expenses, right?
Yes, sir.
So we could just come and say here. Okay, we have already dealt with this cost of sales figure, right?
Yes.
We have dealt with the finance cost figure, so you no longer worry about it. We now need the admin expenses. Okay, it's fine. If you're in the exam now, it's revenue and cost of sales already. So down it would be gross what? Gross profit, right? And then
Yes.
down it would be what? Distribution costs and then admin expenses, right?
Yes.
Distribution costs and then administrative expenses, right? Okay,
Yeah.
I think we are at the point that we need. Whenever we copy the figure there, we'd have to mark and say, okay, update with this. You know, I'm just trying to show you that you can deal with what you have, right?
Yes, sir.
That's what I'm trying to show you. Okay, what else do we have after this? We have the admin expenses, of course. Let's go for our figures because we need it. We need the admin what? Expenses.
Expenses.
Yes. 36 and 25, right?
Yes.
36K plus 25K, and that 25 what multiplied by 6 over what? Over
6
12.
over 12.
Yes, so we say 36 plus 25. This 25 should be multiplied by 6 over 12, right?
Yes, sir.
Okay, now let's go for the amortization. How do we get the amortization? For the amortization, what were we told? We were told that it's 5,000 figure, 5 million, of course, and it had a life of 5 years, right?
Yes, sir.
Come here and add 5,000, 5K,
Divided by 5.
and 5
So you've gone times 6 over 12.
divided by 5 times 6 over 12, right? 5K over 5 times 6 over what? Over 12, something like that. So you
Yes,
just
sir.
skip to the actual computation, which would be 5,000, right?
5,000, yes, divided by 5
Yes, times
times 6
over 12.
over 12.
And then we'd have our figure properly, right?
Okay.
Then, okay, this is not one. We are done with what? With not one. It's fine. You see. So this is how we'll be going through these ones. It's okay. Done with this note, this note, this note. You would be getting these notes. And the other thing, but I don't expect you know to see this in diploma in FRS. Look here. All
Yes,
items in the above statements of profit or loss and other comprehensive income are deemed to accrue evenly over the year unless otherwise what? Indicated. This is the presumption that we always make. You know, when you say if this figure, when you multiply by 6/12, we mean that the first 6 months and the last 6 months are have the same figures. It means each month have the same what? Has the same figure. You know, in a certain year, they brought the exam when they said maybe the company had the peak period and the period which is normal, and the figures were differing, so you didn't have to apportion evenly as usual, right?
okay.
Yes. So sometimes you encounter such things. Okay. So in our case here, maybe or maybe in exam, sometimes you could be trying to do this and check. Right? This is just like an alert. Okay. Now let's go on. Let's go on and proceed with this. We have the pancake group. You can just go and finish up our computation of goodwill, right? We already have the net assets. We are done with net assets. We are done with that working, right? We can finish up. You know, I told you in the working two, if the subsidiary is sold, you can have the provision for realizing the profit, but all those affect the reporting date, not the acquisition what? The acquisition date. So if you are just after the net assets at the acquisition, you don't have to worry about that, right?
Okay.
So you can just get your total here. You could just get your sum from that point to that one, and you close the brackets and get the figure 323. That is the fair value of net asset at acquisition, and we need it here, right?
Yes.
Computation of goodwill at acquisition. So we just say equals to that net assets.
Three,
And yes,
323.
yes. So you would get your goodwill at acquisition at 73,000. I hope you have seen that.
Yes.
Getting your goodwill, I think you can now go on computing whatever else is left. Nothing more, nothing less. Yes. So let's just go on and get whatever remains. Okay. From now on, you can just read something and you finish up with the working. Right. Whatever you choose.
Yes.
Yes, okay. Let me choose whatever I need. For example, let's say maybe I deal with what? I deal with, because the only entries we have remaining are these ones, right? Let's say maybe we are dealing with trying to pick some. Yeah. Yeah, I could pick this, for example. Pancake group policy is to revalue land to make the market value at the end of which accounting period. That's the policy of the parent. But prior to its acquisition, Spear's land had been valued at historical cost. Spear was revaluing at historical cost before being acquired, but it has adapted the group policy since acquisition. In addition to the fair value increase in Sphere's land of 2, so in addition to the 2, as seen in note 1, it had increased by a further 1 since acquisition, right?
Yes.
It has increased by a further 1 since what? Acquisition. So it should be 3 now, right?
Yes.
We are told here fair value of Sphere was 2. Okay. So what should we do? Let's go and look. It's here, other comprehensive income, and we have the gain and or loss on revaluation. Okay, it's here, D3 here, right? It's here. Okay. You know, whenever, like I told you, whenever you consolidate, you only share the equity that increased from the reporting, from the date of acquisition to reporting, right? That's what we usually what? we usually share, right?
Mm.
So you can see there is even that 2000 that was at the date of acquisition itself, it is there, which shouldn't be the case, right? We only want
Yes.
after acquisition what increases, so we need to remove that 2000. Okay, so you can see here after finance cost we had the profit before what? Profit before tax. Let's try to combine this. After finance cost we had the what? Profit before tax, right?
Mm.
And after profit before tax we had the what? Income
Income
tax
tax.
expense.
Mm.
Yes, you can just copy them. Income tax expense. And after that, what did we have? Profit for the
Profit of it.
yes. So you
So
can just go there, also paste it. And then what did we have? Is
now
other
comprehensive
income.
income.
Yes. The OCI, right? You can just
Yes.
OCI. And on the
Even in the exam, I can abbreviate.
no, no. In an exam, you want to do this in an exam? No, in an exam, write it in full.
Okay.
Yes. So you also paid this, gain all loss on revaluation. Of course, we have the figures, so we can just take them. How much? 2000? This is
2,200.
200 negative and 3000 positive, right? So
Yes.
say negative, this one, right? Plus
Yes.
3000, but like I told you, we need to deduct
Yes.
that 2000, right? It is because it shouldn't be there. And here,
Okay.
you shouldn't to worry now and say, okay, I'm going to apportion. No, right?
Oh,
You know, the revaluation is usually done maybe once at the end of the year. It is just done abruptly. It is not like maybe the sales we are making them from the beginning, going on and on and on. It's not like that, right? So whenever you have these revaluation gains and what you shouldn't what you
apportioning.
shouldn't apportion them, right? And that's you can
Yes.
that because you have the carrying amount at the end of the year, and then you just take the revaluation. So it doesn't mean that that gain happened from the beginning of the year to the end, right? We compare the figures.
Yes.
Yes. So it's how much do we get? Let's go here. We said it was negative and 200 plus 3000, right? Minus 2000. And we had that figure. Okay, that is fine. Okay. Yes. And I think we have nothing left here. So we could just highlight. Let's just highlight this and be done with it too. Okay, yes, this is just total comprehensive income. Total comprehensive income, of course, we know about it. It should always be there, right? Whenever we have the income statement, we should always have the total comprehensive income. That is normal. Okay. So I think we just need to finalize, nothing else. We just have like two notes of additional information, two notes of additional information, and then everything should be clear. Let's just write this. Administrative expenses, we had
Why
investment in.
have they gave us gross profit?
What do you say?
Why have they given us a gross profit?
Hey, what is the problem with the gross profit? Revenue minus cost of
But we are supposed to calculate. It's us to find it. Hello?